The companies that are successful, when you look at the clubs and maybe the Quick Wax of the world and some of these other guys that are getting it right and scaling, they're doing a very disciplined approach and just not cobbling together things. And it's just, but this is a longer term business model than I think people coming in thought.
We're in the International Carwash Association's headquarters office in Wheaton, Illinois. Lovely Wheaton, Illinois. It's 1,000 degrees outside, but this is a special visit for Jeff because he doesn't live here, but he comes and visits very frequently. You are, though, based here in the Chicagoland area. So we've got Jeff and we've got Chris here with Amplify, and I just want to set the tone for the conversation. Now, this is a conversation, Jeff, you and I have been trying to have since the beginning of the year. I think we'll blame the scheduling on him, though, right? Wasn't he really hard to pin down?
Always.
Yeah, yeah.
Always.
It's like, get available already, Chris. No, but what's been really fun about that, though, and kind of ironic, is that we had a lot to talk about in January. Then we had a lot to talk about in February, in March, April, May. Here we are in June, late June, early July, and we have even more to talk about. So I think actually the timing worked to our advantage. We'll go back before we can go forward. And one of the ways I just want to set the foundation and the lens, though, is for anyone that's under a rock, or for anyone that didn't see how continued your team is growing and becoming more of a stapled figure at things like the Car Wash Show, as contributors to our magazine, it's important that they recognize how you guys are showing up to the industry and why you're an important person for us to get in this conversation and someone that we want to keep having conversations with. But we're going to talk about some figures. You guys are going to give a really great assessment. We've had this conversation with you in the past, and it's been one that people watched over and over and over again. So Jeff, Amplify Capital Advisors, it's been around for a minute. It's not a new name to a lot of people out there, but when you think about the foundation and the tenure and why it's so important how you approach business with operators, can you just give us a little bit about the why?
Yeah, the why has always been fairly consistent, right? So, we always wanted to level the playing field in representing the interests of the operator. Yeah. Now, I would say with doing that, we have to understand how do you create value for both sides, right? So the best way to have a good outcome is making it a win-win. And so, we felt Amplify's role in this market was to represent the interests of the operator while also helping them understand what fair looks like.
Well, and Chris, the other lens that you guys stand behind too is operator first.
Yeah.
And I'd say in your business, shouldn't it be business opportunity first, not maybe operator first? But that's just not how you approach business.
Yeah, no. First and foremost, going back to the DNA of Amplify, right? Jeff and Bill Martin started Amplify around 2020 with that framework and the philosophy of it's an operator-centric business. The reason for that is if you look at any industry where you have professional deal makers in the sponsor community on the other side of a deal with an independent operator, in most cases, that sponsor striking the deal is going to win. So we saw a real need here, and to Jeff's point, want to make it fair deal on both sides of the equation. That's the best outcome, and that's what we strive to do. That's been central to our philosophy, and we've really immersed ourselves in the operator community. Again, we are operators first and foremost. We have different ventures within Amplify involving early stage tech investments to really give us that 360 view. So what we want to do is we want to be true advisors, not just deal makers, but helping operators navigate the course of marketing their business, but also thinking holistically about how they can potentially improve their operations as they get ready to market their business for a sale.
So speaking of the market and where we are, some would say that, we've slowed down. Things have slowed down. Now, I would argue that that's not what I'm hearing from either of you. Every time I talk to you, you will tell me that whether or not it's above water or just below the surface, there are things moving. And I guess, Jeff, since the beginning of this year, what's been the thing that's been most surprising to you?
Well, so I think we had a conversation last in the fourth quarter.
Yes, we did.
In that fourth quarter, we talked about all the activity that was renewed. We saw this renewed interest that started around the fourth quarter. And the renewed interest, shockingly, was starting to wrap around bigger deals. And we talked about $1 billion in transactions getting closed. I would say the biggest surprise, though, is, and this is it's sort of a surprise, but something we talked about is we can be very optimistic and bullish that I think car washing is going to come back from an M&A standpoint in a very meaningful way. what we can't predict is what around the corner we just don't know. And so sure enough, in the fourth quarter it was a very robust quarter getting deals done. I think we closed $250 million ourselves.
Yeah.
All of a sudden you had this kind of private credit issue come up. And private credit is sort of look at it like the blood that feeds private equity, okay? And that sort of came out of nowhere, and it was driven unrelated to car washing, and it had to do with more other AI and technology kind of things. But the bottom line is that when private credit had issues, private equity had issues. So that was one, and then you got this war that came sort of out of nowhere. And so that sort of was the surprise, and we thought we had some real momentum going and deals closing. And here's the really surprising and good news. Everything that we were working on and everything we thought was going to happen happened. It just took longer. And so what happens and why that is because all of a sudden the private credit people started asking more questions and wanting more diligence from private equity. That is their buyer. So the way private equity is the buyer of these car washes, well, private equity has got to answer the private credit. They just got a lot more questions to answer. And so they were just spending more time on diligence. And all of a sudden, I would say sometime in this last quarter, the comfort level starting to come around. We can get these deals done. And you look at the fourth quarter now, or the second quarter here of the year, we closed, I think, $450 million. And we're poised to close at least that or more, finishing up the year. There's some tremendous momentum. Again, assuming something doesn't happen that we can't foresee.
Well, I mean, Chris, speaking of things that maybe we could foresee or couldn't foresee, there was just a tiny little movement in the private to, or rather public to private move for Mr. earlier this year, which some might say they saw coming. Maybe they had that crystal ball, or maybe there was rumors about whether or not that was always going to be back on the table for that group. But in addition to that shift and the $450 million worth of movement that you guys are seeing yourselves, how does that really shift your read on where the capital availability and that investor appetite really is sitting today?
Yeah, to me it's a positive catalyst, right?
Okay.
So Mr. going back private, sign of commitment from Leonard Green deploying another $3 billion in this space. If you think about our press release, almost $500 million deployed just through Amplify related transactions in the first half of the year. That to me is a sign that this market has transitioned from a niche business and a niche place to park capital to a more sustainable runway here. These are meaningful dollars being spent. So to me, I think it's a positive signal. I think the rationale and justification of taking Mr. back to the private domain is just, again, a signal, the realization that value creation in this space, it isn't short term. It's not quarter by quarter. It's year after year after year. And I think we continue to see that enthusiasm from those who are deploying capital. We're starting to see just continued interest from sponsors who have yet to get into car washing. That also includes, family offices too. I think that's a pool of capital that's been underutilized in car washing. So I think the enthusiasm's there. And to Jeff's point, private credit, they had some challenges to get their arms around when we're in Nashville at the show. We had a number of conversations with those that sit in the seats with private credit funds, and there's still enthusiasm and appetite to put dollars behind car washing in a meaningful way.
Chris said something interesting. I think one of the biggest lessons learned by the sponsors and financial guys coming in the space is this is a long-term business.
Yeah.
And it's becoming a longer term, right? Mm-hmm. The time that it takes to build a car wash and ramp it up takes years. And so the misalignment with sort of short term in and out doesn't necessarily work, right? And the I would say when it first started consolidation, people were going to come in, consolidate, and just flip this thing. And it just proved to be, that was kind of the take fives of the world and zips. We're going to go over very quickly here. That model just proved to be inefficient. This is a very operator, capital intensive business. You got to get operations right to make it work. And just merging in, 25 different car wash platforms that you got to operate is a real problem. And so we're finding that the companies that are successful, when you look at the clubs and maybe the Quick Wax of the world and some of these other guys that are getting it right and scaling, they're doing a very disciplined approach and just not cobbling together things. And it's just, but this is a longer term business model than I think people coming in thought.
Yeah.
And that's, when you ask about the biggest surprise of the year, right? I think, hit it right in the head, right? If you think about private equity in general, we're all in the business of value creation. 2 levers to pull to create value if you're a sponsor: operational excellence or an arbitrage. And we saw the sponsors get in by way of the arbitrage, right? A lot of it's centered around the sale leaseback of the real estate, this very important mission critical asset that sits in the balance sheet for a lot of operators. To me, the biggest surprise, we saw bonus depreciation restored last July. A lot of enthusiasm around sale leaseback of car wash real estate. What I personally love, though, is if you were to look at the cap rate environment, cap rates went down, suggesting car wash real estate values go up. But if you actually look at the list price of car wash real estate since the One Big Beautiful Bill Act, they've gone down, which tells me that the operator community and those platforms at scale that are sale leaseback in their real estate, they're not overburdening their operations with rent that the business can't sustain. They're more disciplined today. And that goes back, every data point that we look at, every conversation, operators and platforms today are just relentlessly focused on improving operations, and the focus is less on how can we create value by way of arbitrage, and it's more about how can we create value through operations. Yeah. Even if you look at new tunnel counts today, right? I was talking with a couple of vendors. The numbers would suggest about 350 or so new tunnels being built this year. It's about 1/3 of where we were at the peak. But where you're seeing the activity is in the reloads and the retrofits and getting equipment in tunnels to deliver an exceptional wash product. And I think that's all just encouraging here. We're starting to see the focus shift again from decisions made in a short horizon to let's be long-term thinkers, because this is a business where there's still an abundance of value creation, but it has to be over 3-5 years, not 3 to 5 months.
And here we have both of you that are, your entire ecosystem is surrounded on the basis of making those deals happen. And yet when you were at our show just about a month ago, the topic that you focused on for your education opportunity was about operational excellence, was about the KPIs. And Jeff couldn't help himself. I'm sure you guys peppered in all the things you could about, this is what we know to be true, this is what's going on, this is how you can be successful in the movement. But I just think it's so ironic that you had the stage to be able to talk about all of these things, and you saved it for this conversation because you knew at that moment to get in front of that many people with that message about operational excellence. That's been kind of a term that's been thrown around a lot, but it does have some value, and as long as people are leaning into that in the right way, I just think it speaks to your point, the volumes of where people should be headed. All right, Jeff, let's talk about in terms of operational excellence and just where people are showing up. Mr. aside, that was certainly a mover and somewhat of a shaker. Who are some other, let's say, movers and shakers that you're kind of keeping an eye on?
Yeah, and you could just see the deal flow getting done. Club has been incredibly aggressive, and I would fully expect them to continue to be aggressive. Quick Quack got. I think they were getting aggressive last year. They got their hands full digesting what they picked up last year, but I fully expect them to get back on board. But then you got, when you look at Spotless, Jax's Holdings. Continues to build out. You got El Car Wash getting aggressive. Whitewater is still doing deals. So and I'm probably missing some names, so don't forgive me if I'm missing them. But when you look at this stuff, we're finding the investment community really bullish about deploying capital in this space. So that gets exciting when you start seeing. And I think and we go back to the growth in this side. I think you've got a handful of these groups that really figured out this business and how to scale it properly, and it becomes a very good business, right? I think the other thing that really should be mentioned here is we're probably at the single best time of alignment between buyers and sellers.
Okay.
So we had this, I think for a long time, you had sellers willing to overbuy in 21 and 22. They're paying up here these 15 high multiples, and sellers were jumping, right? And then all of a sudden, when interest rates kind of started, I would say, now they're normalizing, right? Now they weren't zero, they're not zero anymore. But all of a sudden, you had sellers sitting here with expectations of it going back. Okay. It's just not the case. That was the anomaly, right? Those years. Yeah. And I would say it took a little digesting. It took a little understanding that where we're at today is what good looks like. And I think we're seeing the single best time that I've been around of alignment between buyer expectations and seller expectations. That's why deals are getting done. And so, that's kind of, and it makes it interesting, and we'll find that under the right deal structure and the right terms, we're going to find that there's more and more buyers that want to come into this space and write really big checks. So we're really excited about that, and I think there's a lot of sellers out there now that at least understand what good looks like from a deal. But it's still, the good news is from a seller standpoint, where we're back to is that we recently took a book out to market. A year or 2 years ago, we might have had 10 people interested.
Okay.
Wait, go back to 22, we might have had 50 or 60.
Right.
Right? And then it got down to like 10. So the last deal we just took out to market, we had 40 signed NDAs. So what that's telling me is, and we're seeing now, is that the interest level, we're having broader interest from, like Chris mentioned, family offices and other buyers. So we got broader interest, which presents a little bit more friction on a sales process. And so I think from a seller standpoint, I think this is they're going to find that there's a better opportunity, because with friction comes a better deal for them.
Sure.
We haven't seen that in 3 years. What we're seeing today.
One thing I want to note on the movers and shakers too, common theme with every one of the groups, it's not unit count for the sake of unit counts, right?
Okay.
It's not the race to 1,000 anymore.
Okay.
Hyper focus based on geographical expansion efforts and infilling within core geographies.
Okay.
That is by and large a common theme with what we're seeing with a lot of these groups that are adding unit count today.
Okay.
You think about L, they of course notable acquisition in the Mid-Atlantic, a lot of activity for L going on in the Midwest. Same thing with Spotless, right? They've identified the Northeast as a market where there's white space. They currently have a presence with Flagship, so they're infilling and building density within those markets. And then Club is incredibly disciplined with how they focus on their geographies and core markets. So that is by and large a common theme.
Chris, any, like, in terms of newcomers, or you said regions that are surprising to you as you see it come up? Because I think some of the companies you mentioned, some of those operators, Jeff, they've always been kind of in the realm of like moving and shaking and kind of shifting around, but like they're notable names, right? And those regions are notable.
Here's a new one.
Yeah.
So we had a new one in the West Coast.
Yeah.
A group called Chemical Guys.
Okay.
So they had just entered and acquired Fast Five, a legendary Orange County car wash chain, and that's an example of taking a really, really strong retail brand.
Sure.
And looking at saying how can we make one and one make three, and they're brilliant marketers, and we're going to start seeing, I think, some more interest level from other groups. But this one is going to be interesting to watch, because they've executed brilliantly on the retail side, and I think they can add real value in the space. So we're going to see, I think, some more surprises like that.
Innovation, yeah.
Innovation. Yeah. Moving into space, and that innovation is, I think they're looking at this business saying, when somebody's washing 5 million cars a year or something, there's a lot of value that can be created. And so some of these really, really high quality companies out there could be looking at that and saying, how does AI play a role? How does data? How does technology? Anything? But we're going to see some more innovative companies, I think, entering this space, which is going to make it interesting.
Speaking of other things to watch, we should probably be looking at our customers a little bit, huh?
Yeah,
just like
think so.
seeing what they're telling us.
Yeah, just a little bit.
It feels like they might be telling us a little something different than they had in the past. So, just from your lens in particular, managing that side of the business, from the operations side,
Yeah.
like, what are customers telling us today, that they just simply weren't telling us a year ago, and how is that teeing up, kind of some of these expectations you guys have been talking about?
Yeah, car wash consumers.
Yes,
specifically. Yes. Yeah, that's an interesting one. I think. The Pulse report, I think, shed some really interesting data points here that are worth discussing. First and foremost, we have this, you can't ignore it, a gray cloud over the consumer, right? If you were to look at credit card defaults, auto loan defaults, mortgage defaults, they're all exceptionally high. Consumer sentiment is low. I think a lot of operators have seen that manifest in lower retail volume than you'd expect. But what's interesting, the members are so incredibly enthusiastic. And to me, it's encouraging, because a lot of the thesis underpinning the car wash business has been the resiliency of the economic model, with the memberships and the subscriptions providing that backstop in light of a tougher macro environment. Right. We're at 4.2% inflation, wage inflation has slowed, the consumer is hurting today, but car washes are still doing well because of that membership base. So if you were to look at whether it be the net promoter scores that were highlighted in the Pulse report, I want to say it was somewhere mid-60s, exceptionally high, and that was for their members. You don't see that same kind of NPS translation in the retail memberships. 91% of members intend to renew their subscription. So we're seeing that resiliency, but it's clear bifurcation of the car wash customer, right? The retail single wash customer that has not committed to a subscription, they're not as enthusiastic.
They're a passive player.
They're a passive player, but those members are increasingly loyal.
Yeah.
Globally here, we're looking at some Placer data. I mean, just in Q2 of this year, we hit an all-time high in weekly visits in car washing. So I think a lot of it's supported by the membership base, but we're definitely hearing different narratives across those two different demographics.
Okay. I love this. I love this point. And this is a point that you brought up, I think, when we were talking earlier, which is like the resilience of this industry. You continue to be so optimistic about this industry. And I think like that's probably what makes you such a good partner to work with, is you're like, there's so much out there still. There's so much more meat left on this bone. So what are the things that are popping up that you're seeing that adds to that strength? Why does this industry continue to be so resilient?
Yeah, I mean, first off, we're providing a service, right? And I think, when you look at the last decade, the consumer's mindset have shifted into getting a car wash every quarter, let's say three, 4 times a year, to getting it done weekly, right? So I think the market from that standpoint has done a really good job at now educating the consumer. This is how we wash our cars today. That's pretty good, and it's still a tremendous value when you can you get a membership, wash your car for $30 a month. That's a heck of a value. And so what I would say, where I keep staying optimistic, we see chains. We've got some other chains that we're talking to now about going out to market, these tertiary markets, that had, white space, and we're still figuring out, like, the rule of thumb of how many people you need in a market to satisfy opening a car wash. I mean, it depends on what's drawing that customer. So I think I'm bullish, because I think the consumer now has gotten used to this service, and I don't think it goes away.
No.
But I also think that we know what good looks like. I'm bullish about the guys that have figured out and doing it right. I'm probably less bullish about the guys in that lower quartile that seem to follow the old rule of thumb of just get big fast for the wrong reasons. And I don't see those guys surviving long term. But I do see, like, if you ask me, I see a car wash chain of getting to 1,000 locations in the next 3 years. Absolutely. The guys that are really, really good in this space have figured out how to align cost with delivering a return, and they've done it very good. So I think they're just figuring out how to scale. So that's why I'm bullish. I'm bullish that we're figuring out what good looks like, and we got more data points. There's definitely going to be, I think, another few good years of growth. We're still way behind a lot of other industries. It's still highly fragmented in a lot of ways.
Right.
There's definitely room to be excited.
Chris, any big movements that you guys are anticipating, whether we're naming names or not? I'm assuming we won't, but just like, are you guys hearing or seeing anything that could be as big of a shift that could be a signal for maybe some other operators to be looking at?
Yeah, not naming names and not, no insight here.
They're going to tell me offline though, and I can't wait, and then I'll have to sign an NDA.
If we were to just think about kind of the early entrants in the car wash sector, the sponsor-backed platforms, I mean, a lot of those holdings are long in the tooth. They're breaching that 5-year hold period, and we all know how important that is for sponsors to recycle capital. So if you think about that, and if you were to look at just the emergence just of that top 10 segment, you could definitely foresee a world where you see a fair amount of consolidation within that top 10 universe. That could be pretty exciting here.
You would bet to say it's going to go consolidation versus, like, could it ever fragment out? Could it ever, kind of collapse within and separate out from a fragmentation?
So go back to fragmentation.
Totally.
I just think there's too much capital that's been deployed to see that happen. I think the unit level economics prove out to be so attractive at scale when you have larger quantities of units, but with discipline behind it, right? Not just growth for the sake of growth. So it's hard to envision kind of reversal of the thesis and the narrative that supports this industry from a long-term standpoint, which is the ability to scale and achieve exceptional unit level economics.
I think you're spot on. I think actually we're just at the beginning.
Just starting.
We're at the beginning of consolidation, and the like I said, the handful of groups that have figured it out are going to be stepping on the gas and accelerating that consolidation at a much quicker level. I think the independent operators, you look at it. An example is, I've got somebody in Colorado who's got a few good car washes, but they're surrounded by a chain that's got 30 in that region.
Yeah.
And she says, I don't understand why, we've got a better location, but they're a mile away. And I go, because they can build a brand with 30 locations. They got a marketing engine. They got a promotion engine. There's things that can do. And ultimately, I think there's exceptions to that. I mean, you got really strong brands in the region. Take
Sure.
Car Wash or Metro Express. These are guys that are just dominant in their regions, and they're just you can never unseat them if they don't want to be, right?
Yeah.
But I do find that the brands that are filling in their footprint on nationwide, at some point they just don't care who's there.
Yeah.
They're going to be able to build let's say a Club Car Wash or something else on everywhere that their customers are going to be in a certain market, and they'll double down on it. And I think at some point, I think you'll see that they're going to have much quicker acceleration of growth, and I think you'll find a lot of the smaller operators just not being able to compete because of that.
That's a really important thing to kind of maybe dig into a little bit, is the idea that the independent operator, I'm not saying you said this, but doesn't stand a chance, right? Because they're up against this monster, this machine that has all of the resources available to them that they couldn't possibly. Now, but I know that you stand for the independent operator also. I know that you back them and you want them to be successful. So Jeff, as we're thinking about all of this information, if I'm a 3-site operator and I'm in a great community and I've achieved operational excellence, how does what we're telling them today help them continue to be successful?
So a couple things I'd be thinking about, right? One is, how do you differentiate?
Okay.
So here's one thing the big chains have a disadvantage. They are standardized, process-driven business, right? So if they're going to run an express wash business, that's all they're going to do, right?
Yeah.
So if you're an independent operator, let's say you can pivot and do a flex wash operation. 2, let's say you're in a small market, in a small community, you align yourself within that community. You become the community's car wash. You're working with the local high schools and teams, and do your managers become brand ambassadors in that community. So I think you've got to win with boots on the ground.
Yeah.
And you've got to differentiate your customer experience, because you're both wash your cars. So that's the only way I would look at saying, start thinking outside of. You're not going to compete with them head on, otherwise you'll lose.
Yeah, I think, the advantage that the independent operator does have, though, is you think about kind of operating hundreds of units across multiple geographies. A lot of the most successful platforms that grew to success because they had operators that were living in those tunnels, right? They had their finger on the pulse of their business. They delivered exceptional customer service, and I still think that's something that's highly relevant today, because PE has yet to figure out how do you scale that. And I've been saying this for a while. I think one of the biggest risks in this industry specifically is lack of operating talent. This is a very unique business. So the leg up for the independent in that framework is the fact that they are independent, they are in market, they are ingrained in the community, and they know what's going on in those tunnels day in, day out. They live in those tunnels, and that's just something you can't AI away.
Ooh, speaking of AI, we didn't even plan this, but that was
pretty
my
good segue,
next.
right?
That
There we
was
go.
my next tip. Was give me your sense on how companies really can, no matter the size, no matter the appetite for scalability, how can they deploy a tool and a resource like AI to kind of take that step forward, differentiate, be more successful? We can't have a conversation without talking about AI. I would probably get tons of comments about it. So just give me the skinny kind of on that.
But my philosophy in this, I'm going to steal something from Adam Treen of Amp.
Oh, nice.
One
He's
of the
a good
best,
person to steal from,
great
for sure.
technologist, not just in the car wash sector, but broadly
Yes.
speaking. AI bridges the gaps between data and decisions, right? So I think
yeah.
that's the most
Beautiful.
effective way. I'll give you, for our car wash operation, we're big believers in providing optics to our on-field, on-site teams. Every morning, director of operations would pull KPIs, stats, below narrative.
Okay.
Pretty labor intensive, right? We now have an API into Claude, and every day Claude's sifting through our point of sale system, producing those KPIs and putting the narratives of areas to focus for that day ahead. What's happening now is my director of operations, instead of spending an hour plus every morning, he is now able to allocate that bandwidth to other value-added aspects of our business. And I think that is, by and large, AI isn't just a full-on automation tool. We're going to have a bot make decisions for you. It's going to help expedite the time to make those decisions. But if anybody's out there looking for summer reading, there's a book, Human Plus Machine, and the thesis here is just simply that AI is going to allow individuals to reallocate bandwidth and time to other high value added opportunities.
Yeah.
And I think that's what we're seeing in the car wash sector today as well.
Well, and I'm hearing too that, like, Jeff, exactly to your point, that with that added time, because you're not 100 plus locations.
No.
So what you're doing is exactly what we're getting advice on, which is like literally take the extra time and put boots on the ground.
Totally.
Be in your community, immerse yourself there. So whether AI can help you do that or not, but get there.
So we're still really excited about what good looks like, right? I think the good news is we're starting to learn what good looks like. I think AI helps us get there quicker, right? Because the one of the most valuable thing you have going for you is your data, right? And the more you can get to know about your data and your customers, tells you about how you can better serve them,
decisions.
even the decisions on how you operate more efficiently. Because AI is way more does way more than you can think. How you manage maintenance and staff, and I mean it's a game changer. That efficiency goes all the way down to the bottom line. And so when you look at Amplify and say, what are we trying to accomplish here in the space? We're always thinking of saying, how do we deliver as much value as possible to the operators, right? And so when we went on this soapbox about KPIs, and now we'll get back on with our summit and all that good stuff.
Right.
We feel compelled that knowledge and education could start leveling the playing field for a lot of people.
Yeah.
But it's not as hard as you think. But you need to know first you got to start with knowing what good looks like. You got to start knowing what's possible. And there's so much stuff coming at you. So the world is moving very, very quickly here.
Yeah.
And so who do you trust? So at least what we're trying to do is stand in this role of saying, okay, we're going to give you the knowledge and the information, what's out there and what good looks like. It's up to the operator to take advantage of it. And at some point, hopefully we get a customer. But in the meantime, our role in the space is going to continue to drive value everywhere we can.
Yeah, incredible. Now, I mean, there's really nothing left to ask from you guys all outside of just when you think about the remainder of this year and looking ahead to starting anew in 2027 with a fresh 12 months ahead of us. Like, are there any not I wouldn't say words of wisdom, but any crystal ball kind of ideas that are coming up that you want to make sure that people are thinking about and leaning into for the 6 months we've got left, and how they can prepare for the future?
So I'll take it first. I'm going to let Chris finish, close it out. The really, really good news is we have not seen activity on the deal size we're seeing like we have today. So what that tells me, there's a lot of pent-up demand from operators that just get a little bit older. There's family succession, whatever the reason is, but we're seeing a lot of good opportunities that are coming to market, and I fully expect that we'll see a very bullish M&A environment, at least this year and going into the next year, assuming nothing that unpredictable happens. My big advice, though, is going to be, with that said, there are a lot of operators and there's a lot of people knocking on our doors. And this I would say every deal we do is 10 times harder than it used to be.
Yeah.
Okay.
And we're answering 10 times more questions than we used to. And I would say every deal that we're doing now has some kind of structure. How is that structure getting done? The bottom line is the math's got to make sense for the buyers, right? You've got to understand their cost of money is twice as much as it was a few years ago, and the margin of error is so low. We've got to structure a deal that's going to make sense. And so the more educated you can be as a seller, you'll avoid a lot of mistakes. The other thing is that even on the terms they're saying, there's a lot of terms here that are gotchas, and all I can say is that my advice is that the good news is I do think good deals will get done.
Okay.
I do think that the amount of education that the seller needs to have, be prepared, because the diligence request and how deep these guys are looking is far more than it's ever been.
Yeah.
and just get somebody on your side that's got your best interest. This is the good news is there's opportunity here, but you got to know what you're getting into.
Yeah, that's really good advice for the seller too, to make sure that they're buttoned up and that they're expecting that level of due diligence. And if they're in a process now, maybe that is seemingly moving fast and simply, they should probably think that as a blinking yellow or blinking red light, right, Jeff? Maybe just take a minute.
Yes,
That's great.
Okay.
spot on.
Okay.
No, I think prediction finish up this year, going into next year. I mean, buckle up. I think structurally, there's just a lot of things that would all suggest just a flurry of activity is on the horizon. Stepping back and looking just kind of broadly at capital markets, highlighted a few trends already, but you have the sponsor community in general, not just in car washing, holding on to companies for longer. If you're to look at just the ratio of private equity company inventory to exits, it's north of 11 to 1 today. Historically, it's 6 to 1, meaning there are 6 portfolio companies to every 1 exit. So less transactional activity, holding on to companies for longer, and you have $1.3 trillion of dry powder in the sideline. What does that mean? Well, they have to recycle capital. It's going to have to happen. You look at things like Mr. going back private, they're back in their front foot today. We'll see what they do in terms of investing in technology and participating in M&A.
Right.
Already mentioned some of these sponsor holdings in car washing getting long in the tooth. And then if you take a step back and look at just the environment we're in today from a macro perspective, pretty big reversal in the cost of capital environment. Right? A lot of people are expecting rates to eventually tick downward. New chairman of the Federal Reserve was very clear in his first meeting. Priority 1, 2, and 3, combating inflation, which is currently at 4.2%, getting it to the Fed target at 2%. So we're actually now forecasting a reversal, more of a hawkish policy. The dot plot's going to be about 25 basis point increase is what we're now forecasting. But in general, the Fed is now a lot less willing to give forecasts, right? It's very, very adamant about that. So I think where I'm going with this is you have a cost of capital environment that is elusive and probably going to be unfavorable, which gives a 6-month window here to close out the year. A lot of structural dynamics I think is going to force activity here. So it's going to be really interesting having a conversation going into early 2027 about what just happened.
I'd like to reserve the right to have you on call. And if I might not be able to convince you to come back in Chicago in the middle of the summer when there's things like Cubs games and guaranteed beautiful weather, Jeff, but maybe we can get you back from Arizona for another time, maybe later this year, to just kind of keep giving us this pulse.
We'd love to do it.
Absolutely.
I think it's so important because the information that gets out to market.
Oh gosh.
And I get calls every day from sponsors to all kinds of people, and the amount of BS that gets fed out there. And again, all we're trying to do is, we're not sitting here, nothing we're going to tell you except that we're sitting here trying to just make up or guess. We have data, right? We have real data. We have deals that close. I can tell you exactly what multiple we're paid and how the deals were structured. And then we've got another $500 million out there. We know how people are bidding. I can tell you how much, what the level. So there's nothing we're sitting here making up. There's just so much junk being spread out there. We're just trying to keep the space a little bit honest and do our part, and we'd love to be back on it at the end of the year and see how close we come to our predictions.
Oh, I love that. If we're as close as I think we will be, then I will figure out how to get you a crystal ball. I already have ideas. And whether or not it's a working one or not, there's some sort of physical thing that we'll talk about later. But thanks so much, guys, for just for hanging out in our office, which was so fun. But just for sharing some of this important information at this point in time. I think it was really critical.
We appreciate the opportunity, Sean, with your...
Always love the time.
Great. Thanks, guys.